stand by. We're about to begin. Good day and welcome to the Targeted Loan Acquisition, a Smart Approach to Asset Growth conference call. Today's conference is being recorded. At this time, I would like to turn the conference over to Al Fontova. Please go ahead, sir.
Well, good afternoon. Hi, this is Al Fontova, and I am a Senior Marketing Manager here at Harland Clarke Marketing Services. And I am responsible for working with probably our most exciting suite of solutions, which is the business intelligence and analytical solutions. We've got a great lineup today and a great turnout. This is actually a record turnout for us for these webinars, which we do pretty frequently, so we're pretty excited. So, we see a lot of people out there. I want to welcome all of you, Judy Current, Kathy Martin, and all you other wonderful folks who showed up today for this webinar. Today our topics can be very timely. I think all of us within the financial services industry understand the difficult conditions that we've been working under for the last, probably 24 to 36 months. Everyone's institution today probably has, a great bit of deposits on their books today, and they're looking to make new loans. So this is probably one of the key reasons why, this webinar is so well attended, is we all want to go and make new loans, and hopefully I think that you're going to get a lot of great information from our two panelists today in showing you some tactics and strategies you can put in place immediately to help move you down this road to making more new loans this year. So I just want a few housekeeping items for this webinar before we get going. We always get this question, and yes, copies of all materials will be made available to you after the webcast. So we will look for an email. It'll probably go out in the next day or so, and in that email you will see a link to a web page. Click on that link and you can go and download all the presentation materials that you will see today. And also there will be a recording made available to you that, in case you want to revisit the webcast or possibly share it with some of your colleagues, it'll be really easy to do. So look for that email within the next day or two to receive your materials. Questions during this event? Yes, you can ask questions at any time. So during the presentation, if you've got a question that pops up as you're reacting and digesting the material that's presented to you, you can just go right to the chat window on WebEx, type it in there, send it, direct it to the panelists, and then our presenters will take breaks probably towards the end of each section and answer as many questions as possible during the presentation so that it's fresh and timely and relates to the material at hand. Any questions that we can't get to, we will have a Q&A session at the end of the webcast. We'll open up the phone lines at that time so you can go ahead and answer or ask your question verbally, or, if you like, you can also use the chat feature at the end of the presentation. The last thing, any questions that we don't get to today, if they're not answered during this event, we will be sure to make note of who asked the question, and then we will email you a response from our panelists within the next day or so that you definitely have a response and get your questions answered that way. So, without further ado, let's get going. Let me go ahead and let's talk about the agenda that we've got today. So we have a very crisp agenda. We're going to talk about really two items here. So first, the state of the industry. We're going to talk about loan marketing, what's happening today, some of the things that are happening out there in the macro economy that you should know about that look like some very positive indicators for 2013. A lot of good things are starting to happen. We're starting to see some indicators turn up. And we'll have a presenter go ahead and review those with you so that you understand what's happening with the broader economy at large and how that impacts loan marketing specifically. Then we'll go ahead and roll into the heart of the presentation. We'll talk about the loan marketing ecosystem. We'll look at strategies and specific tactics that you can take to move your new loan programs forward and get more loans on your books. So, and then at the end, of course, we'll do question and answers. So let's look at our speakers. We've got two great speakers today. Steve Nikitas is a senior marketing strategist. He has deep experience in financial marketing. He's been the VP of a financial institution managing their marketing program. So he knows firsthand, what works, what doesn't, and again, deep experience in working in this industry. He also works with a multitude of different clients today in helping to make different strategic recommendations, helping them solve their marketing problems to move forward. So Steve is he's a key asset to us here in the Marketing Services Group, and I think you will find his take on what's happening today in the economy and with loan marketing to be very interesting. Sandeep, he is our VP of Business Intelligence. He has very, very deep experience working in this space. He has worked for some marquee names, marketing services agencies we won't mention by name since they're competitors, but he has been working in this space for over 10 years. And again, great deep understanding of business intelligence and analytics, and more importantly, he can communicate, some of these complex ideas and programs. I think, at a level that all of us, like me, for example, can understand and really make things like statistics, business intelligence analysis very practical and something that we can do and implement and execute against, and not just really an exercise in analysis itself. So those are our two speakers today. So Steve, why don't you go ahead and take it and tell us what's happening out there today.
Okay, well, thank you very much, Al, and good afternoon, everybody. It's a pleasure to be here, and thank you for taking time out of your busy days to join our webinar. Over the next several minutes, what I want to talk about is really the state of the industry, and in particular, what's happening when we look at the asset side of the balance sheet and where our challenges are. To do that, I wanted to just share this information with everybody and talk a little bit about what's going on out there today. No surprise to anybody, we're in a very challenging economic environment, right? We've seen the economy coming back from the recession in a very slow growth pattern. Last week we saw Q4 GDP numbers which were negative, unfortunately, and hopefully that's not a sign of more things to come, but maybe a blip on the radar screen. We see regulatory issues coming fast and furious with us, or to us rather. Dodd-Frank in process of being implemented, and hardly a day goes by where we don't hear more challenges around these regulatory issues coming at us from both the feds and the states. And all of that has left the consumer in general very uncertain. And to compound on all that, we saw what happened early in January when consumers started getting their first paychecks and saw the federal tax bite a little deeper than anyone had expected. What does all that mean? From a trend perspective, our loan to deposit, our loan to share ratios are the lowest they've been in 30, 35, 40 years, depending upon whether you're a bank or a credit union. Coming out of the recession, consumers really did a good job of cleaning up their balance sheets, their personal balance sheets, and did not look for credit, but looked for ways to pay down credit. While all that has been going on, we've seen increased competition in the marketplace, not so much from new entrants to the markets, so to say, but really we've seen a lot of merger activity, and we've seen a lot of bigger players come into the market, and that merger activity is continuing to take place pretty much on a daily basis. On average, we're seeing one credit union. On average, we're seeing one bank merge with another on a day-in, day-out basis. But all of that, because of where our loan-to-share and loan-to-deposit ratios are, we are challenged to grow the asset side of the balance sheet. As financial institutions have cleaned up their balance sheets, many have jumped back in, if not all. Banks and credit unions are really focusing on loan growth in 2013 and beyond. So how do we take advantage of that? The keys to what financial institutions should be doing out there is, A, be very proactive. Stay on top of your customer, your member needs, and find ways, which we're going to talk about, to be proactive rather than reactive and be in front of the consumer as their need for credit materializes. We want to, at the same time, be very smart about who we're marketing to and identify those consumers who are out there shopping for a loan. We'll talk more about that and in a few minutes. And then we also want to look at opportunities to bring loans back in the door that for one reason or another our account holders may have gone to another financial institution to obtain. So we'll talk about loan recapture opportunities in a little bit. Where do we see the opportunities? Certainly in auto, and most definitely we see opportunities on the mortgage side of the house. So I mentioned earlier, loan-to-share, loan-to-deposit ratios are challenged these days. They're at basically historic lows. The blue line on this chart represents data through Q3 for both banks and credit unions. The blue line is the loan-to-share ratio for credit unions. The green line is the loan-to-deposit ratio for banks. What's driving this? Certainly the consumer hesitance up until most recently to look for credit, and at the same time that flight to safety that we're seeing account holders pursue as they've sat on the sidelines relative to the stock market and elected to invest their money in both banks and credit unions. However, of late what we're seeing, this chart shows outstanding consumer credit, and what we're seeing is the consumer slowly getting back into the market, getting back into the need to borrow money. And so we're seeing a definite uptick in demand for consumer credit. The challenge for financial institutions is obviously to take advantage of this and find ways to get back into the consumer credit game. Where are the opportunities? This chart shows the average age of cars and trucks on the American roadways today. And you can see going back all the way over to the left-hand side of this chart, since 2002, we've seen a steady increase in the average age of cars and trucks on the American roadway today, so that we're at a point where that iron that we're passing on the highway every day on average is about 11 years of age. There is significant pent-up demand among consumers for new cars and trucks. This is something that we want to take advantage of. This chart portrays new vehicle sales, not new and used, but just new vehicle sales in the United States. Look what happened in 2007 at the outset of the recession. Literally, the demand for new cars and trucks in the United States fell off the table. In that 2-year period from 2007 to the depths of the recession in 2009, the new auto market fell by a third, a historic significant drop in demand for cars and trucks. But since then, we've seen a steady increase in consumer appetite for new vehicles, and the expectation is in a couple of years we'll be right back to where we were pre-recession. So there is certainly demand out there for automobiles, for new trucks. While there's demand for cars and trucks, at the same time we're seeing increased activity out there for home purchases. This chart reflects U.S. home sales prognosis going out to the fourth quarter of 2014. This is both existing home sales as well as new construction. You can see where we've taken it since the end of last year. The expectation is that we'll be to a point in a couple of short years where we're seeing home sales back up in the 5 million range on an annual basis. So definitely consumers have jumped back into the market for new homes. Rates are attractive, prices are attractive, and the consumer is out there shopping again. With that, what I would like to do is I would like to move this presentation over to my colleague, Sandeep Karidi. Sandeep is going to talk about strategies and tactics that we can employ in order to take advantage of this demand for certainly automobiles and homes. Sandeep?
Thanks, Steve. Good afternoon, everyone. Welcome again to the webinar. We're excited to have such a large group of our clients, both credit unions and community banks across the country. What I wanted to do is spend some time going over this framework of a loan marketing ecosystem we have created, and then within each component, we'll go into a little bit of detail around what it is and some of the recent success we have seen. So on this next slide, what we have here is the basic construct of a loan marketing ecosystem. And what we see here is there are three primary components. We're calling it demand fulfillment, demand generation, demand creation, all around loans. And then these three strategies and components within the ecosystem contribute to strong new loan growth. Demand fulfillment is basically some of your own members or customers are in the market actively shopping for a loan product, or they could be prospects within your footprint that are shopping for a loan product, and we're fulfilling that demand via a very timely offer to that account holder. And then demand generation, the middle section, is where a consumer, could be your account holder or a prospective account holder, has a loan with a competitor. And by analyzing the characteristics of that loan, we're able to send a very targeted offer that shows tangible financial benefit to the prospective borrower for them to refinance their loan within your institution. And then finally, with demand creation, that's the part of the ecosystem where a consumer does not have the subject loan we're trying to market to. However, they are creditworthy, and there's something happening within their life stage or household that indicates a higher propensity to acquire a new loan product. Moving on to the next page, to understand the return on investment with these programs, essentially demand fulfillment, our product name for that is Shopper Alert, which I'll go into in a little bit. That delivers the highest return on investment because it's timely, but we're not going to have a lot of volume. It's going to be very targeted, small volume, but delivers the highest ROI. The next component is demand generation or loan recapture from competition. That presents a larger universe size than Shopper Alert and delivers the second highest ROI. The ROI is lower than Shopper Alert because the consumer is not actively shopping. They may or may not think they're in the market. However, an offer that's very customized to them, would prompt them to consider your offer. Then the last piece with demand creation, this presents the largest universe size, but also has, within these three categories, has the lowest return on investment because these consumers are not in the market actively looking, don't have the loan product already. However, these are three complementary loan strategies. We would recommend approaching it in this order. So if there is enough marketing dollars just to do one program, we would recommend Shopper Alert. If there is additional funds beyond that, we would recommend demand generation or loan recapture. And then if there's still additional goals or funds available, then we would recommend demand creation. The way we see it, we implement it, these are complementary. There's no overlap between the three segments. You will have certain prospective loan borrowers that could fit in more than one of these areas, and we manage the overlap the way we implement these programs such that the consumer is not receiving multiple offers or with competing messages, what have you. On the next page, let's look at some background of credit bureau data, and basically what credit data is. For some of you may not have background. We have a good mix of clients where some of our clients have done a large number of loan marketing programs with using credit data. Others perhaps not as much, more reliant on mass media. So we wanted to provide a little bit of overview of what the credit bureau data contains. Number one, it's highly regulated. It requires a firm offer of credit. We would need to review the creative closely. There are disclosure requirements that go along with it. There are a large number of attributes available per credit bureau. There are three primary credit bureaus, Experian, Equifax, and TransUnion. The data is very predictive. Some of the sample attributes, the obvious one is FICO score. Most people would know what FICO scores are. However, there is, dozens and dozens of other attributes where we can get very very, very precise about making sure the recipient of an offer would not get declined for credit reasons. Things always change after we send the offer. They may have had a negative trade, hit their credit report, filed bankruptcy, what have you, that we can't control for. However, when we credit screen, the number of declinations are very, very low compared to the overall business. On the next page, there is a range of other marketing data that we have access to that we complement with credit data as needed. This ranges from demographic data, basic things like age, gender, education, what have you. There's public record data, particularly for mortgages, so we know how many liens are on the property, who the lenders are, what type of loan it is it fixed or adjustable, is it a 15-year, 30-year, what have you. Some of these elements are not available in the credit databases. Others are. There's also life stage data. Some common examples are new movers and new parents. There's business data, firmographic data, things like SIC codes, revenue sizes, years in business, number of employees, what have you. So what we're trying to say is there is a ton of marketing data out there that could be leveraged, and some of our more sophisticated programs combine credit bureau data with these other non-credit attributes to create very targeted and robust marketing programs. With that, let's get into the individual components within our loan marketing ecosystem. The first thing I wanted to cover is demand fulfillment or shopper alert. This next page shows you a graphic of which conveys the crux of the program, which is an ability to reach your account holders currently shopping for new loans. And we offer 4 loan products within the solution: mortgages, auto loans, personal loans, and credit cards. And we like to start this with your existing account holders, and then once we have 3 or 4 months or so of the program running, we have some quick wins, some ROI and metrics established. At that point, we would recommend adding your non-members or non-customers, your pure prospects that are within your trade area and meet the credit requirements. On the next page, here are some major highlights of the solution. Again, it's a way to identify qualified retention and cross-sell candidates who are actively shopping. I want to underscore qualified because we apply all of your credit criteria, and the declinations from the solution is still going to be there, but it's very, very low. We work with all 3 credit bureaus on a daily basis, so we're receiving alerts from the 3 credit bureaus Monday through Friday. There's a 24-hour lag, so basically one of your account holders inquires for a mortgage today. We receive that alert first thing tomorrow morning, and then a phone call or mail piece or email, some combination of the 3 goes out tomorrow. Same day we receive the trigger. So very, very timely. And the reason that is critical is what we're finding is once somebody starts shopping and they do a credit pull, they work with the lender who does their credit pull, within 5 or 6 days from that event, 2/3 of them have already made their buying decision. There's going to be a long tail with the remaining third who may still be interested in considering competitive offers. But what we're finding is very, very critical to get in home, to get in their mailbox, to talk to them, and if they're still, make sure they are aware of your offer and what you're able to do. And after that, the conversion response rate really drops. So one of the fundamental things with our solution is a rapid fulfillment in terms of messaging. Again, that could be multi-channel or any one of the 3 channels I just mentioned. We also built into the program is an ability to measure results. So we provide ongoing monitoring. We share what products are performing, not performing, which of your members are receiving the offer but haven't responded, the ones who've received the offer, did they fund, did they get declined, withdrawn, what have you. So there's a lot of ongoing measurement that helps us, fine-tune the program over time. As part of this assessment, what we can do is, for those of you who are interested in considering this, kind of creating a potential sizing of what the opportunity could hold, we offer at no charge an analysis. We call it the 30-day look-back analysis for Shopper Alert. So on this next page, you'll see that an example of what this analysis might look like. So this is a summary report we show that says, in this case, the client had 92,346 households, and within the last 30 days, 7.5%, almost 7.5% of their account holders had shopped for one of the 4 products. On this next page, you'll see that we also break this down by product. So we can show what percentage of the triggers came from mortgage versus auto loans, credit cards, and installment or personal loans. In this market, vast majority of triggers we're seeing is for mortgages. Usually that number ranges from on the low of 45% to a high of 55%, like you're seeing in this example. And then the remaining products, our 3 products make up the difference. And there's a little bit of variation depending on the part of the country we're seeing this mix. It also varies by credit union or bank. Some clients have a large number of credit card trigger activity. Others have more personal loans and auto loans, so it just varies a bit. And then on the next page, what we're also able to show is a proxy for creditworthiness, because if you're wondering, yes, some of my customers, members are out shopping, but do they really qualify for one of your loans? So what we are showing here is it's a distribution of those triggers by FICO score. And in this example, 83% of customers shopping have credit scores over 650. We've seen that dip on the low end to maybe 70% or so, over 640 on the high end, maybe 85, but more than 2/3 for any institution of more than 2/3 of these account holders shopping, have very strong credit and would qualify for one of your products. Now, when we implement the program, we're going to have more criteria than just FICO score. For example, we can say for mortgages, minimum credit score is 640, no bankruptcy, no foreclosures, no delinquency in the last 12 months, what have you. So that can be very detailed. On the other hand, for personal loans, since it's unsecured, you're going to take more risk. We can say the minimum credit score, the FICO score, is 700, and maybe we're tighter on the delinquency. So it can be as customized as you need it to be. Typically, what we do is we work with the loan underwriting area to look at your credit policy and match it very closely to the credit bureau attributes. On the next page, another critical component of the solution is we work with all 3 credit bureaus. And the benefit of working with all 3 credit bureaus is that you're maximizing the total number of triggers that you have access to. For this exercise here, what we have done is such that we don't double count or triple count. We only count the trigger one time, even though multiple credit bureaus report it. You have situations with mortgages, for example. A lender may pull a tri-bureau merged report. In that case, all 3 credit bureaus will report that trigger. And so that we don't overstate the opportunity, we count that as one time. In this case, just for the purposes of the analysis, we put Equifax in first priority, Experian in second priority, and TransUnion in last priority. When we implement the solution, that priority order can be whatever you wish. And basically what that's doing is if Equifax reported a auto loan trigger, and then TransUnion reported the same auto loan trigger. We're only counting it one time, for Equifax. This does not mean that one bureau can provide more triggers than others. It just means the credit bureaus do have some unique triggers that they report. So by working with all three, we maximize the total opportunity, total pool of prospective borrowers we can reach out to. Okay, on the next page, here are some results from a credit union we have been working with, and this client has been with us since May of last year. It was our first client since we launched. They, on a relative scale, on the smaller side, they have about 20,000 members, and we're marketing 3 products for them: mortgages, personal loans, and auto loans. And they've opted out of doing credit cards because they don't have an in-house portfolio. And we've mailed out about 3,400 offers through the end of last year. And as of December 31, we had 239 loan applications from those 3,400 offers. 140 of those have been funded. We still have a couple dozen loan applications pending or in progress, so the results are not complete. And the 140 loans amounted to $10 million in closed loans. Most of them, as you see here, is mortgages, and then we had a little over $1 million in auto loans and a small number of personal loans or unsecured loans. Overall, the net was over 7% application rate, and the blended marketing cost across all of these products was under $75. And prior to this program, the best loan campaign the client had, the cost per funded loan, the marketing cost per funded loan was about $400, $500. So we've been able to, with this solution, bring that down. So in essence, the total opportunity sizing may not be more. It's not like we'll have, for a relatively a small or mid-sized institution, we're not going to have hundreds of thousands of offers we can promote every year. However, the offers we do promote are going to be very responsive because of the timing and the nature of these triggers. That concludes demand fulfillment or shopper alert. On the next section, let's go into demand generation. Again, demand generation is maximizing usage of existing lines of credit as well as capturing loans from your competition. And I'll go into a little bit of detail into what both of these mean. A little bit of overview on the next page on HELOC segmentation. Our goal here is to drive incremental net income by maximizing the value of your existing portfolio. Now, if you have a sizable personal line of credit, unsecured line of credit portfolio, conceptually it works the same way. What we're trying to do here is, across the industry, we work with a large number of clients. What we see is the average line utilization rates on a HELOC is about 35%, give or take a few points. And what we're trying to do with the solution is increase the initial activation rates and also increase ongoing usage. And what we've been able to do is get the utilization up to closer to 50%, which means potentially millions of dollars in additional borrowing and proportional amount of interest income that goes with it. On the next page, here's an example of a HELOC segmentation, the way it might work, and this is only a sample. In this case, the client had about a little over 25,000 open HELOC accounts, and analytically, we established 7 segments, and we created a priority for each segment. So they range from 1 through 7 here. So these are newcomers, people who have just opened a new HELOC account in the last 6 months. And the second priority is people who have shown that they can draw frequently, and so on. The idea is to create relevant messaging for each of these segments, and also vary the frequency of these offers to each segment. Our frequent drawers, for instance, may get a letter with checks, for example, 4 times a year or 5 times a year. Another segment, may only get it, once or twice a year. And what that does is, rather than promoting the offer to everybody within your portfolio once or twice a year, it just allows us to allocate the marketing dollars, a little, more smarter and get more return for that. On the next page shows some recent results on the HELOC segmentation work we have done. Again, we had a mail quantity of a little over 16,000 HELOC account holders we sent the offer to. These offers ranged from sending 2 checks versus 4 checks, or just a message, talking about the HELOC, introducing the product to them. What you're seeing here is the response rate, and response here is defined as at least 1 draw against the HELOC post-campaign. That ranged from a low of 2.2% all the way to a high of 36%, and then a blended number of about 20%. And when we have a mass kind of marketing campaign, typically that where one offer goes out to everybody and everybody gets the same messaging, we see about a 5 or 6% response rate. By doing the segmentation, we're able to multiply that almost 4x. And we increased the average utilization in the portfolio from the baseline to over 8%, and that accounted to over $27 million in new balances, and that was just a single campaign. The segmentation works best if we have a good-sized portfolio. What we find is typically that is about somewhere around $10,000–$15,000 open, or 10 to 15,000 open HELOC accounts is a good baseline. If we have smaller than that, then we would recommend more frequent messaging and measurement that goes with messaging, and perhaps not the analytically driven segmentation, because it doesn't allow us to work with the segmentation without an adequate sample size. So that's the first part of demand generation. And this next slide, we'll get into loan recapture, or capturing loans from competitors. And as you see on the next page, the idea is simple. We're looking to acquire auto loans, home loans, and mortgages from competition. Using the credit bureau data, we can get very specific in terms of payment savings we're able to provide. We can also use non-credit data or public record data, particularly for mortgages. It works really well. And on the next page, it shows you how a auto loan program would work. So we're targeting consumers with a specific savings message. So we look at consumers who have an auto loan elsewhere. They're within your trade area. They meet all of your credit requirements. And then we look at the data within that auto loan, the current balance, the term, the interest rate, how much they have left, how long they've had it, et cetera. And then we come up with a customized savings message based on what they might qualify within your institution, and then send a very targeted offer that says, by refinancing with our financial institution, we're able to save, say, $50 or $75, and that number is specific to each individual. And then on the next page, the mortgage and home equity loans, works similar. However, we wouldn't recommend sending out an exact payment amount because of the ways how different lenders report payment information to the credit bureaus. Some lenders include escrow, others don't include escrow. So rather than that, we look at origination dates and we proxy what type of interest rates they might be paying, and then the messaging that goes out is more focused on interest rate rather than a specific savings amount. On this next page, we see an example of a recent mortgage loan acquisition campaign. This is a client of ours on the West Coast. They have about 200 branches, sizable institution, and we've been doing weekly campaigns promoting HARP loans. Again, HARP loans, I'm sure many of you know what that is. It's a specialized loan available through both Fannie Mae and Freddie Mac for borrowers who have been on time with their payments, however, have not been able to refinance in the past because of not having enough equity. The results here, this is a weekly program in all of their markets. We mailed, as of end of December, we had mailed about 75,000 offers. This was all prospects, no customers. To date, we have $45 million in funded loans, and that equates to a little over $500,000 in net income before taxes, and the return on investment and the marketing spend of 225%. And this client has basically renewed the program throughout 2013, and we'll keep running the program through the end of the year, and hopefully there will be an extension of that, going into next year. That concludes demand generation. This next piece, we'll talk about demand creation. I'm not going to spend a lot of time on this. Our recommendation is this component makes sense only if you're already leveraging Shopper Alert and recapture programs and have, additional loan goals, marketing budgets, to get into the demand creation piece, because we feel the ROI is lower here than the other two programs. So the next page kind of lays out the tactics and strategy. What we're looking for is mining your account holder base for and prospect base for new loan opportunities. These are things like new car buyers, new home buyers. We're also mining your existing account holder base for credit card, personal loan cross-sell opportunities. And on the next page, again, a little bit of overview. It works best for credit card and personal loan cross-sell offers. We've seen a lot of success with this. It also works well for auto loan pre-approvals. The issue there is the consumer you're sending the offer to, may or may not be in the market for a new car. So you never, so there is, the adoption is not going to be as high as you would see, within Shopper Alert or loan recapture. We would not recommend direct marketing to solicit mortgage loans for home purchases. Our experience has shown that first-time home buyers or home buyers in general, they're difficult to target via direct marketing. It's not an effective channel because once somebody, even if they're in the market, it could take them 6 months to a year to fund, to actually make an offer, purchase, fund a loan, what have you. On the next page, here's an example of a client where we recently did credit card cross-sell. This was a Visa cross-sell into their existing member base. This is a large credit union on the West Coast. They are about $8 billion in assets. And the campaign launch was in mid-October. The product was a standard Visa offer to existing members. There was no specials attached. We mailed a little over 15,000 offers. The direct response rate was 3%. So the direct response is basically of the 15,000, 3% of them came in and applied for a credit card. So where the application was completed and credit was pulled. And then 2/3 of that, 2%, of 15,000, or 2/3 of the 3%, were approved and issued the card. That translated to a little under $50 in terms of marketing costs per new card issued. In addition to the credit cards, we also had personal loans and a sizable number of auto loans that the campaign generated. We see this a lot where a consumer gets the offer, they call in or go into a branch, and once they meet with the financial advisor or your branch personnel, they may determine that they have a need for another product, either in addition to the one we offered or as an alternative. So, and the way this campaign was targeted is we had this credit union has over 500,000 members, and we had over 300,000 of those members who met the credit qualification, and we used a propensity model to determine the top 15,000 offers or members to send to. And based on the success of this campaign, we're now moving to implementing quarterly programs, doing Visa cross-sell into the program for the rest of this year. With that, that was the end of the slides here. We have about 10 minutes left for questions. I'm going to ask Steve, while we're asking for questions, I'm going to ask Steve if he has any additional thoughts.
Sandeep, the programs that you had gone through, I have worked with a number of financial institutions in my role here as a strategist at Harland Clarke, and unequivocally, my experience has been that they're all very effective programs and are helping financial institutions really get more lift out of their loan to deposit or loan to share ratios. So financial institutions are finding value in each of the programs that you've gone through.
Okay, great. Al, or the operator?
Back to you.
Yeah, hey, that was great, Sandeep and Steve. Thank you. Very, very good stuff here. All right, so we've got a lot of questions coming across here. So let me go ahead and let's see. I'm going to go ahead and read out the question just so that we all hear what the question is, and then we can go from there.